This is part 2 of our Chapter 4 video lecture, where we're continuing to talk about merchandise inventory, specifically purchasing merchandise inventory. But before we take a look at that type of transactions, let me briefly mention there are two broad categories of inventory systems. One called perpetual, that's what we're studying here in this Chapter 4, versus something called periodic systems that is covered in an appendix to our chapter 4. And you're not going to be responsible for this periodic system. Like the name implies, perpetual systems perpetually keeps track of your inventory, keeps track of how much you have left over after buying and selling throughout the month or the year. In the case of the periodic system, you are keeping track of what's being purchased and sold, but you really are not keeping track in detail how much you have at any point in time until the end of the period where you take a physical count. You go around your store and count how much is left over. Now, you still do that physical count for the perpetual system because things may have happened that haven't been entered into your system yet, perpetual system, like theft, like deterioration of the inventory. But you should be always knowing, because of the computer technology, keeping track of what's coming in and going out of your store and warehouse, always knowing how much you have on hand perpetually, continually. So this part 2 deals with purchasing merchandise and how we account for those transactions using debits and credits, journalizing those transactions using this perpetual system. So let's say we have a transaction here on November 2nd where our company, Zmart, purchases $500 of merchandise and making the payment right away, spending the cash. So we know merchandise inventory is an asset, and here our assets increasing with debits. But when we make the payment, that's cash asset being reduced with a credit. Okay, so just like buying something like supplies. But remember, supplies is something what we consume ourselves within our business. Inventory, merchandise inventory, is purchased with the intent of reselling it to a customer. Yeah, this is our main business, buying and selling merchandise. Let's take a look at an example. If we don't have to pay right away, but we're given credit terms, so we're buying the merchandise on account, and typically the terms will give us a due date. So here you're buying the merchandise on this date, and now you can wait and hold on to your money and making sure you have enough on the due date over here. Now, some sellers will try to motivate you to pay off earlier by giving you a discount because they need the money to hopefully pay off their bills on time. So here again, we're purchasing the merchandise, but instead of paying it off on the regular due date down here, if we pay our bill off early, here a few days after the purchase date, the seller will give us a discount here during this discount period. Now, if we miss the discount due date, we will might as well hang on to our money and wait for the regular due date and pay off the whole thing over here. So let's take a look at an example where we're given a discount. The way to read this shorthand of writing out a discount is that there's going to be a 2% discount if we pay off our bill within 10 days of this purchase date. Okay? Otherwise, the whole bill here called net is going to be due at the regular 30 days after the purchase date. The way to pronounce these terms here is called 210 net 30. We get a 2% purchase discount from the viewpoint of the purchasing company. In the viewpoint of the selling company, this would be a 2% sales discount. If the buyer, the purchaser, pays off the bill within 10 days, in other words, they're paying off 98% of the bill here by the 10th day after the purchase date. Otherwise, 100% of the bill is due within 30 days of the purchase date. Here's an example of a bill or an invoice. So this invoice is generated by the seller. The company is Trex, and the customer, that's us, is Zmart. Here's our employee, the purchasing agent for Zmart, Tom. And back on October 30th, Tom placed an order, a purchase order with Trex, ordering these two different items here. So now, well, we purchased the item, we got delivery, and now also we got a copy of this invoice. Here you can see we bought one item here and one item here, two different items, and we have the price for each item. We would extend or multiply across to get a grand total. If we were paying the shipping, that Zmart, we would see shipping costs here arranged by the seller. Also looks like there's no taxes here for sales taxes. So we're going to pay $500, and the terms say we can wait 30 days. In other words, here we bought it on November 2nd, and we can pay off our bill of $500 by December 2nd. But the terms also provide for a discount, a 2% discount if we pay our bill within 10 days of November 2nd. Here you can see the discounted price then would be $10 less, yeah, 2% of 500, yeah, netting to $490. What else is here? Here you can see who is paying the shipping costs. We'll have a slide dealing with this here, but FOB stands for free on board, and the seller will get that goods all the way to our company, the destination of Zmart's store, and it's coming by FedEx. So here's our transaction again on November 2nd, but this time we, Zmart, is purchasing $500 of merchandise, not by paying cash right away, but buying it on account or on credit. And here are the terms, 210 net 30. We get a 2% purchase discount if we pay our bill off within 10 days of November 2nd. Otherwise, 100% of the bill is due within 30 days of November 2nd. So you don't wait to record this transaction when you pay off your bill. You purchase it right now here on November 2nd. So we go to our journal and journalize this transaction. On November 2nd, at least two accounts have to change. And here, one of them is the new account we're learning here in Chapter 4, an asset called merchandise inventory. Products or goods we're buying that we plan to resell. So we just increase this account with a debit, increase this asset. And we're not spending the cash right away, so we're not crediting cash, but we owe the money using this general liability account called accounts payable, increasing accounts payable liability with a credit. And you can see a short explanation here. Probably what you should be doing here is referring back to that invoice here, yeah, for more detail. So let's pay off our bill early. Again, within 10 days of that November 2nd purchase date, we're going to pay off our bill. So when you pay off your bill, you no longer owe $500. So here the accounts payable liability account has to be reduced by all of that $500. But you're not spending $500 because you got a 2% discount. In other words, 98% of this amount, or here you can see the calculation, comes down to a payment of $490 cash credit. And we know back from chapter 2, in any single transaction, the total dollar debits have to equal the total dollar credit. So we need $10 more credit. And because now the inventory is costing us less, we got to reduce that inventory asset with a credit. Okay, so total debits 500 equal total credits 500. And the rule was at least two, in this case, three accounts are changing for a single transaction. So if you were to post now from that journal into the general ledger accounts, just for those two entries, you can see the original entry posted here. debit the merchandise inventory, increasing that asset, and crediting the liability for the full amount. And then within 10 days, here on November 12th, we're going to pay off our bill. So reduce the whole liability here, right? It zeroes out that one Trex amount. And then the amount of cash we're paying is not $500, but only $490 due to the $10 discount here. So the net cost of that merchandise is not 500, but here you can see now we reduced it down to $490. So let's say that that discount didn't take place. We didn't pay off within 10 days. So we might as well wait and hang on to our money to the last moment we can. And here now, 30 days later, after November 30th, we pay off our bill. Not with any discount, but the gross amount. So we zero out the liability with a credit, just like we did before. But this time, you got to pay the full cash credit, $500. Now, there's other types of transactions that can go along with the purchase of merchandise. For example, maybe the merchandise that's delivered is defected, or maybe something that we didn't order, maybe like the wrong size or the wrong color. And so we contact the seller and we say, this is not what we ordered. And to just keep things simpler, the seller says, no, keep the merchandise. What we're going to do is reduce the price for you, here called an allowance, a purchase allowance from the viewpoint of the purchaser. And we'll see sales allowance in our next video. Or we're going to return the merchandise, ship it back to the seller. In either case, what we're going to do is reduce the amount we owe, reduce the accounts payable, and um, and also possibly reduce the cost of the merchandise. So let's take a look at some example transactions. So after we purchase the merchandise here on November 5th now, we find that $30 of the merchandise is not acceptable. But instead of, again, shipping it back, the seller is going to give us an allowance, a reduction in the price. Okay, so here we're going to reduce the liability, debiting the liability for that allowance. And then, because the cost is not as great as before, we're going to also reduce the cost of the inventory asset with a credit. So there should be some type of documentation, something like an adjusted invoice, yeah, that now gives us the information to record this journal entry. Again, this is an allowance. We're not shipping back any merchandise to the seller. We're keeping it, but we're reducing the purchase price, reducing the cost of the asset. So let's say that this time, $250 of that merchandise. Okay, we're buying merchandise of $250, yeah, with credit terms of 2, 10, net 30. So here on June 1st, you can see the recording of the purchase. Debit merchandise inventory asset increase, okay, with a debit. Credit accounts payable liability increase with a credit. And then 2 days later on June 3rd, Zmart says, hey, $50 of this stuff is not what we ordered, or please take it back and give us a credit. So here we can see we're going to return the merchandise inventory, crediting the asset, reducing the asset, and also reducing the bill, the account payable liability. Remember, liabilities increase with credits, but here we're reducing it with a debit. So basically, we're just reversing this 250, yeah, for the amount we're returning. Now, when we bought the merchandise here back on June 1st, there were terms of 2, 10, net 30, a 2% discount if we pay within 10 days of June 1st. So let's go ahead and pay off our bill here 10 days later on June 11th. So we're going to reduce the liability for the remaining amount we owe, not 250, because remember, we already reduced it by the item that was returned by $50. So zero out the liability, debit liability. Now the cash we pay is not 200, but we get a 2% discount. And that discount is not on all of this 250 we bought, because remember, we returned $50 in merchandise. So it's 2% of only $200 or $4 discount, reducing the net cost of that inventory asset with a credit. Again, the two credits here has to equal the total debit here, yeah, in this single transaction. So here in this slide, we're talking about who is paying the shipping costs. So here is the seller's location called the shipping point, and we're going to ship it all the way to the buyer's location called destination. So typically when you look at the bill, the invoice, it's going to have a freight or shipping terms. Again, FOB stands for free on board, free on board. And here, if it says FOB shipping point, that means right from here, now the buyer is responsible for the shipping. Yeah, the buyer is responsible for paying for this transit. In case anything goes wrong here along the shipping, the buyer is responsible. That term again is called free on board shipping point. The cutoff is right here. Yeah, seller's responsibility, buyer's responsibility. And when the buyer has to pay the shipping costs, typically the seller will make arrangements and tack on the shipping costs on the invoice. Yeah, or if you have to pay directly the shipper, this company that's doing the transporting, here you can see the cash is being spent, or maybe accounts payable if you're getting billed but haven't paid it yet. And you increase the cost of the merchandise that's being shipped with a debit. Now, if the terms of the shipping is FOB destination, that means the seller is responsible for all of this transit costs and taking the risk of any liability if something happens here, and then drops it off at the destination, where now the buyer takes legal title to the merchandise. Now, if the seller has to pay the shipping costs, just like we saw on that invoice, the shipping costs to the buyer was blank, right? But now when the seller pays that amount of the shipping costs, here you notice, again, cash or accounts payable will be credited, but the debit is not merchandise inventory to the seller. You cannot debit merchandise inventory to the seller because the merchandise is sold. It's not here anymore. So what we have here is a new selling expense or operating expense called delivery expense, or sometimes they call this freight out, shipping to your customer. Okay? When the buyer pays merchandise freight costs, it goes into the cost of that merchandise inventory. When the seller pays the shipping costs, that cost is classified not as merchandise inventory because you don't have that inventory anymore. We debit delivery or freight out expense. So here we have Zmart. They're going to pay for the shipping costs. So we debit the merchandise inventory for whatever merchandise is being shipped to us, and then either cash credit or accounts payable credit. Here's a summary of how we calculate all of the costs for purchasing merchandise. So here's the gross cost we got billed from the seller. But then if we're given a discount for paying off our bill early, we can subtract that out, subtract out purchase discounts. And if we return merchandise, or if we're given an allowance, we keep it, but given a reduction in price, that's an allowance, we also subtract that out. Notice how we combine, the returns and allowances into one account or one amount here, total. And then if we, the buyer, has to pay shipping costs, here called transportation in, we're shipping into our company, versus shipping out to our customers. Okay, we add that cost in to the total net cost of purchasing merchandise. Okay, so go ahead into the part 3 video where we're going to now take a look at selling the merchandise using this perpetual um, merchandising system.